Chipotle stock had the biggest stock split around a month ago. For every share you own, you got an additional 49 shares. Now, as you know, stock split, nothing changes with regards to a company's valuation. Think of it as a pizza pie. It's the same pie, just more slices, so more people can get access to it. Employees and or investors. Now, since then, since think mid-June or so, stock is down 20%. Now, usually when a stock split is announced, then the stock goes up for some reason or another. And then when the stock split happens, then of course it's like a buy the rumors, sell the news type of thing. Stock goes down a little bit because again, nothing changes fundamentally for the business. So since mid-June or so, the company, the stock is down 21%. Now, tomorrow on Wednesday, they will report the next quarterly earnings. So stay tuned for that. But in this video, let's focus on what has been happening with Chipotle, with the stock, and with the business. So if you're interested in all of that, sit back and relax, hit all the buttons, like, subscribe, notification bell on. I would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's start with a major overview so you are fully ready for the earnings report. So Chipotle has a market cap of $73.5 billion. It's up 28% year over year. Year to date, it's still up 17%. Now, over the last 10 years, you can see that the business has been doing quite well. Revenue has been growing steadily. Free cash flow has outgrown revenue growth. Return on invested capital sits at 17.2%. Very, very good, especially for a restaurant business. Gross profit and net income has exploded in the last couple of years. Now, of course, with all that said, the, let's say, number one point I hear when talking about Chipotle is valuation. And rightfully so, because essentially you're buying a restaurant business that is trading at a multiple only seen in tech companies. So if you look at forward PE, 46 times. Yes, it is lower than its 5-year mean of 53.8 times, but 46 times, that's quite expensive. EV to EBITDA, 31.5 times. Price to sales, 6.3 times. Price to free cash flow, 55.5 times. Then price earnings to growth, just over 2, which is okay. It is not the cheapest out there, but we've seen way more expensive ones. But overall, yes, the stock, even if it's down 20% from the June high, it still trades at quite a premium. But as you've seen in the last 5 years, I can even show you the last 10 years, it has always been trading at such a high valuation. Now, does that mean that you have to buy this? No, but there is a reason why it is trading at such a high valuation, because it deserves a premium. It is a restaurant business that is generating a lot of free cash flow, very, very profitable and still growing. So if you compare it to its peers, yes, it does stand out. Quickly looking at what the analysts are thinking here, they still have a high price target, actually 23-24% higher than the price we're at today. As you can see, the average price target has increased in the last couple of months. So most analysts are still quite bullish on the company. And so overall, looking at the stock's performance in the last 5 years, it's up 258.7%. Of course, since that hit that the restaurant business, the industry, should I say, took during the pandemic, it has been, well, recovering quite nicely and then some. If we look at the analyst estimates for the coming fiscal years, sales growth of around 15% year over year on average, EPS growth closer to 20%. So again, you're paying a premium, but this still is, for a restaurant business, a business that is growing quite fast despite its size. But earlier this month, we did get some negative news for that industry. So restaurant stocks drop as industry data shows earnings recovery may be slow. So Bird's data showed that casual dining comparable sales in the most recent week were down 6%, which was below the negative 3% level for June and Q2 overall. The fast casual segment saw sales growth fall to just up 1% year over year from a pace of up 3% in the prior week. Another analyst at KeyBank warned that investor sentiment is poor on global fast food names and expects the earnings season to be underwhelming. We believe several brands within our coverage universe are at risk of missing consensus same-store sales forecast for the second quarter. And to be honest, it's not as if fast food has become cheaper and better. No, prices are quite high. And so as the consumer spending slows down, as people actually watch what they are eating and not willing to spend that much, because Chipotle is definitely not cheap fast food or cheap, let's say, casual dining, if you want to call it that. It is not cheap, and so people might not spend that much money anymore. On the flip side, people still need to eat, and it's not as if other options are way cheaper. So you have to balance it out. Of course, again, on Wednesday, we are going to get the earnings figures, so that will tell us definitely something more, but the stock is down 20% month over month, so that might already give you a small opportunity, let's say. Now looking at the first quarter numbers, total revenue increased 14.1%, comparable restaurant sales increased 7%. Now this was a good one. Operating margin was 16.3%, an increase from 15.5%. Restaurant level operating margin was 27.5%, an increase of 190 basis points. Diluted earnings per share came in at $13.01, a 23.9% increase from the $10.50 we saw same quarter last year. And they opened 47 new restaurants within 43 locations, including Chipotle. The CEO said we had another outstanding quarter driven by our improvement in throughput and successful marketing initiatives. The results we are seeing from our focus on developing exceptional people, preparing delicious food, and fast throughput gives me the confidence that we can achieve our long-term target of more than doubling our business in North America and expanding internationally. And this is basically what you should be looking for. A good entry, because this is a good business, good management, definitely good track record as well. And the peak has not been reached yet. So it's all about finding the right price to pay for this stock. As for the outlook for 2024, they expect full-year comparable restaurant sales growth in the mid to high single-digit range, 285 to 315 new restaurant opening with over 80% having a Chipotle, and the last one, an estimated underlying effective full-year tax rate between 25 to 27% before discrete items. And as you've seen before, the analysts are expecting sales growth of around 15%, EPS growth of around 25%. And so right now, looking at the stock, this is on the weekly, you can see that we are just under, or well, pre-market, we're just at the 200-day moving average. Previously, when we revisited the 200-day moving average, we did go for a week or two under it before recovering. So maybe this time we can have the same scenario. Definitely a better area to enter right now or add to your position. But as we've seen, this is not a cheap stock. This is a very, very good company and good business, not a cheap stock. If we look at the daily, you can see that we are oversold. Well, we have been oversold for the past 3 days. So risk reward wise, yes, it is much better right now than before. And previously, when we went under the 200-day moving average, we were not oversold as right now. So that's also, let's say, something that you can put on the positive side of things. So overall, to conclude, I would say that if you hold Chipotle, then tomorrow is a day where you will get just more information from management and then see if you want to add or not. Right now, I don't really like to play the earnings, let's say, gamble. I did before, didn't really work that well. Worked sometimes, but overall not worth it. Because if you have a position, then if the stock does go up, then your position is worth more and then you have more information to make a more educated decision. If you do not have a position, then buying 1 day before the earnings is basically gambling. You gamble on the fact that tomorrow will be a good earnings report, and so you will be up tomorrow. Now, of course, you can open a small position right now. In case it's a good earnings report and your position is up, and then you can add more with the extra information that you're getting. That's just how I'm thinking right now if I am willing to play the earnings game. Overall, 1 day before the earnings report, I usually just like to sit on my hands, wait until I get more information. Yes, maybe I will pay 5-10% more, but at least it's a more educated decision than the one that I'm making right now. Overall, Good company, good business, but expensive stock. That's about it for this video. Of course, do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.